In this presentation, we will take a look at the income tax formula. You'll recall from a prior presentation that the income tax formula is one of three approaches that we want to learn the tax code and tax preparation within. We want to understand the tax preparation in terms of a general formula. That will be the easiest way to visualize the taxation. Then we want to basically see that formula as it relates to actual forms, such as the 1040, and we want to be able to enter this information into software. Those are the three approaches, and in practice, we put these approaches together in some fashion. For example, when we learn the taxes, we're going to be wanting to think of it in terms of formulas. If you go to learning taxes, you take courses and classes. Unlike this course, most courses will actually just basically say, hey, this is how the law changed. It changed this part of the formula, basically. And they won't even give you any visuals oftentimes. And you have to have an idea in your mind. Well, what does that mean in terms of the actual end result, or what are the effects of that? And you have to just basically know that in terms of formula. The only way you can do that is simplify, distill what's happening down in your mind to basically a formula that is happening. You can't really envision every line item on the form and the actual text that will help you to calculate through the forms. But once you see the forms, you want to basically apply your formula to the forms. You want to have some type of visualization of the formula in form basis. And you want to be able to then at least go through a few times, of course, the forms within the system and read through them to see how the form kind of walks you through what the formula will be. And then we will be using the software, which will help us to do some of the data input, jumping from a data input screen and visualizing the data input screen and what will then happen to the forms. So you want to then put information into a data input screen, have an idea of the formula in terms of a form basis, and visualize that. So to know the formula, it's going to look something like this. This is going to be the formula that we will be considering. Oftentimes, we'll actually enter information into the tax system in terms of forms and think about the formula and verify what's in the tax system by formula. I would use an Excel worksheet to do that. So here's an Excel worksheet with the formula. Excel is going to be much more close to basically working this thing out by hand. We're just going to say, oh, let me just put it into a formula by hand within Excel, laying out each line item of the formula and then tying out all the key numbers to the tax return that we can. So when I think of the formula, how can we verify with a formula? I would think about calculating something in Excel. That's going to be as close to paper and pencil that we need to have the transparency to visualize what is going on. Once we know the formula, then we want to be able to look at the 1040 and not be overwhelmed by just look at all the numbers and data here. We want to then expect and say, okay, I see the components of the 1040. I see that the first part of the 1040 is related to the formula of the taxable income or the gross income type of components, and so on and so forth within the 1040. That makes the 1040 something that doesn't make your eyes roll over when you look at it, because you know the components. You know how to break it up into its parts, what those parts mean, and then consider each of those parts. Now let's take a look at the formula line by line. Remember that the formula is in essence, or at least the first half of it, will be in essence an income statement. A very unusual income statement because it's going to be related to taxation, but we are talking about income tax. What that means, we need some type of income statement. We need some type of statement that shows how you did over time. Performance statement, earning type of statement, as opposed to a balance sheet type of statement, which says how you are, where you stand at a point in time. We want to know the activity, performance over time. That's going to be the income statement. Therefore, we will start off with income. So we'll have income. That will typically be the W-2s and other types of 1099s and other types of income that we will have. We're going to group all those things together conceptually into income. We'll talk more about each of these lines, what could be included in income, in a future presentation and expand on them. That's one of the second ways that we're going to go into the components and break the taxation down into components and consider each part. So when we think about income, that's a huge topic in and of itself. What is included income? What is not included in this line item? But from a formula basis, we're going to say that's going to be the first component of income, all the things that are going to be included within income. Then we're going to subtract from that the deductions or adjustments to income. Now, this used to be, you're going to hear different kind of variations between this. It used to be called an above-the-line deduction. You might call it an above-the-line deduction as opposed to a below-the-line deduction, which would be like itemized deductions. That's kind of possibly an old term after the changes to the law last year, because they now put these deductions not directly on the 1040, but a separate schedule. So it may now be called like a Schedule 1 deduction. So if you're talking to someone that's been doing tax preparation for a long time, they might have a term like an above the line deduction or something like that. Those are going to be the deductions. What you want to know is these are deductions that are going to be separated from the larger the deductions that are most common to our mind when we think about types of deductions, which are going to be the itemized deductions. So these are the other deductions other than the itemized deductions. And then we're going to subtract that out and we're going to have a subtotal. The subtotal is going to be called adjusted gross income. So we can think about all the income, kind of the W-2 wages, as basically our gross income. Then we have the above the line deductions. And then we're going to get another subtotal, which will be adjusted gross income. Now, this is an important number because this is kind of like the sub number that will often be used if we're talking about phase outs or something like that. If we're talking about credits that have some kind of phase out or something like that, oftentimes they don't use the income number, but the adjusted gross income number for those phase outs. So this is the adjusted gross income, might be termed the AGI type of income. Then we get a little bit more complicated. We're going to subtract, and we have an option here. We subtract either the standard deduction or the itemized deduction. Now, of course, when we're thinking about taxes, what we want to do is make our income as low as possible. You'll know that normally when you're talking to people, people want to look better. They want to say, hey, they want to basically show that they're doing well. Typically, that's what people would naturally want to do. When you go to pay taxes, it's the opposite, right? The things that are bad, you want to go and say, I make no money. I don't have any money, right? So the deductions are usually the good thing. The deductions are good. The expenses are good. Deductions are like expenses. So when you think about taxes, if they're taxing your income, then of course income is basically bad for taxes, right? Because if the more income you have, the more penalty you have, and in essence, tax that you'll have. So really everything's kind of backwards the way you would normally think it. So on income, the question is there income that I can earn? I would like to be able to earn income and not have to legally, and put it on the tax return. So the question there is it something that's taxable in terms of taxation? Do I have to include it in income? I'd rather not, because if I do, it's going to have to pay taxes. I would like my income to be lower. If I can have the income to be legally lower under the tax code, that would be beneficial in terms of paying less taxes. I would like to have my expenses higher. So notice that the deductions are basically kind of expenses. Usually expenses are a bad term. For taxes, they are a good term, because expenses mean that they're going to be taking down your what would be net income, which usually that's bad. You would like your net income to be high in real life, right? Normally. However, for taxes, the lower your net income, which we'll call taxable income, deductions, expenses, taxable income, lower the taxable income, the less tax you actually pay. So for taxes, if we have a choice to say which one do we want, these are deductions, these are expenses. Expenses are usually bad in real life, but they're good for taxes because they lower the taxable income. Therefore, we want to take the greater of the standard deduction or the itemized deduction. So notice these are the two groups of deductions we have right now. We've got the itemized deductions and we've got the deductions or adjustments to income, which could be called above the line or Schedule 1 deductions. Most of the deductions that people think of that have been traditional kind of deductions that are just in people's minds are the itemized deductions, the charitable deductions, the mortgage deductions. Those are going to be the itemized deductions. So when you think about those deductions, remember that you can only take them if they're greater than, or you're only going to get a benefit to take them, if they add up to something greater. All of the itemized deductions adding up to something greater than the standard deduction, which is more difficult after the more recent changes to the law because the standard deduction is higher, which should be a good thing. That's one of the ways they're trying to simplify the code, is to basically say, I would like to have more people just taking the standard deduction and all these things that have kind of accumulated over time in the itemized deduction, which means you have to kind of gather all this information together, or you might have to gather it together if it's greater than the standard deduction. We're just going to make that so it's not there as much because most people will take the standard deduction. So I'm not trying to say that the law is good or bad. There's going to be winners and losers to any kind of change in the law, but the bottom line is you want to take the greater of the standard deduction or itemized deduction, and after the change in the law in the prior year, it will be the case that more people will typically be taking the standard deduction, and which is a higher deduction. So that's generally beneficial. If you're taking the standard deduction now because it's higher than your itemized deductions, that means you should be getting a greater deduction, and you don't have to basically put together the itemized information. But that's still going to be a recent change in people's minds. But the bottom line here, you take the greater of these two items. Then you're going to say that that's going to give you the taxable income. So you had your income minus the above the line deduction subtotal. Then you're going to take minus the standard or the itemized deduction. You only get one of the two. You want to take the greater of them. That will then give you your taxable income. Now you can think of the taxable income as similar to net income on an income statement. That's going to be kind of like the net income on the income statement. Now the second half of the formula is then to say, okay, there's our net income. There's basically our income statement. Now we want to think about how we're going to apply the tax to it. So generally for taxes, you want the net income to look bad. You want it to be lower. So you're trying to say, what can I do in terms of income? I'd like to have income that the tax code doesn't require me to include as income on the tax return, so that my net income would be lower. I would like to have my expenses, which they call deductions, as high as possible, so that my net income is as low as possible. My taxable income is as low as possible. Then we're going to be on the taxable income, thinking about the second half, which is the tax calculation, and then the payments and credits. So now that we have the taxable income, we're going to say, well, what's the tax on it? We apply the tax rates, which could be the tax tables we've talked about in prior presentations. So that's going to be a progressive tax system, not an easy thing. We can't just multiply times one rate, not a flat tax, as we've discussed, but we're going to apply the tax rates to it. That'll provide us the tax before any credits and payments. So this would be basically our tax liability before we consider credits. And we have to consider the difference between credits and deductions now. So the credits are down here. Credits are typically going to be more beneficial. We'll talk about this later because they're going to be equivalent to payments as opposed to the deductions up top where we only get a deduction of the income, not actually basically a dollar for dollar back. We'll talk about that more later. So then we have the tax before credits and payments. Then we're going to subtract out the credits. Typical credits might be an earned income credit and a child tax credit. The credits are a bit confusing, however, as well. We got to break out components or categorizations of credits too, because the credits, usually when we think about an income tax, we think about us paying something. A tax is usually bad for us, right? We're going to owe something. We're going to have to pay something. It's a bill to us. However, there are some times when we actually don't owe any tax and we get something back. For example, if we had the tax liability here, let's say the tax liability was $100, and then we had credits down here that are going to bring, and we're not talking about payments, we're not talking about anything we paid in, we're saying the actual tax before any payments we made during the year is $100, and then we had credits. Is it possible, let's say the credits were $500, well then, if that were the case, that would mean that we didn't pay any taxes in, and we would be getting money back. We call those, that would be a refundable credit. So the question is, well, can that happen? Is it possible for me not actually to pay anything in and yet still get money back? It is, and we call those the refundable credits. So notice the confusing thing there is it's not really a tax. If that happens, then it's not really a tax that's happening. We're talking about, in that case, it's a beneficial, it's a program, it's a social program that are actually providing it. So we're doing it within the tax system, but no tax is being paid. We're not talking about a refund coming back. We're talking about a zero tax liability and still getting paid back based on a social program using the tax code. So to do that, then we have to say, well, most credits, we'll say we're not going to do that. Most credits, we're not going to be saying that it's going to be giving you a refund past any payments that were paid in, right? It's not going to take your tax liability to a negative to result in a refund due to the credit. So we have to break that out then. So credits that are not refundable credits and credits that are refundable type of credits. We'll talk more about that later. And then we could add other types of taxes. Other types of taxes might include something like a self-employment tax or an AMT tax, alternative minimum tax. We'll talk more about those later. And then we're going to subtract out finally the payments. And you'll recall the payments are going to be something that is withheld from us, withheld from our W-2 typically for most people. So typically when you have a refund for most people, a general refund would be that the payments that you put in on the W-2 are actually designed to be higher than the estimated tax liability. Therefore, you get a refund. And because you paid more in than you actually owe. That's different than the situation where the credit is actually taking your tax liability, to a negative number, so that you wouldn't owe any tax and are actually getting a refund even if you didn't pay anything in. And that's why we also have the refundable credits here. So down in this line item, we're going to say, hey, these are the tax payments and the refundable credits. Those are the credits that are going to basically allow you to get a refund, get money back, which isn't really a refund, right? Because it's not refunding an overpayment. It's more like a social program that's giving money back based on the credits. And some credits that are refundable will typically be part of the child tax credit, and the earned income credit will typically fall in to have a refundable portion to them. And that will give us the taxable refund. So in future presentations, we'll then break this down to each component. So you'll note that each component of these are going to have more complications to it. Income's going to have more complications. What type of income falls into there? What are the different adjustments that we have? So if you're going to a lecture that's talking about changes to the adjustments or types of adjustments, you're visualizing that it's in this line item, and then you're getting into more detail. You're drilling down in more detail. What are the itemized deductions? We'll list those out, right? What is the tax rates? We already talked about that. What types of credits fall in here? Then we got to break, we can expand that. What types of credits fall in here and what's going to be the portion that's refundable, which would fall down here, and not refundable, and we'll get into each component. When we think about the tax forms, then we can break these out. For example, the income section will typically be the top part of the 1040. So up here's where typically the income components will go. We'll have the wages up top. We'll have the interest, the dividends. Those are all falling into the line item of the formula of income. And then we'll have more income, additional income on Schedule 1. And then the adjustments, the above-the-line adjustments, which you would call previously, now might be called Schedule 1 deductions if this takes hold for a long period of time. And those are going to be down here. And they'll break out, and then we can get into more detail of the components, the detail that would fall into that line item.